back to Credit Lens Europe and Beyond. I'm Phoebe Apinting.
And I am Katie McMahon. And on this week's episode, we are joined by Wayne Jambawo, financial analyst at Octus and Arsenal fan. He is going to talk us through why the scorching weather across Europe this summer has a knock-on impact for Europe's high-yield issuers.
And then we're going to be talking about Virgin Media O2, or VMed O2, with a 22 billion capital structure. There's always something there. We're going to talk about its convoluted vendor financing notes. And then maybe we're also going to talk about its 200 million shareholder dividend. Who knows why they paid it?
Sounds good to me. But before all that, a quick reminder. This podcast is for informational purposes only. These are our personal views. They're not the views of Octus. They're not the views of any affiliated organizations. And this is not investment advice. But as for some advice I hope has been heeded, I hope nobody looked directly into the sun during last week's solar eclipse, which we are gearing up for in the studio today.
Exactly.
How do you feel about solar eclipse? Phoebe, excited?
It's exciting. I'm like, as you can tell.
Tell me another lie. You could not sound less.
I'm going to go to the gym. No offense. I don't understand this hype about it. I've seen a few eclipses in my lifetime.
Come on. You've not seen one like this since 1999, surely, unless you've been...
1999. That will put me at... Let me not date myself.
I'm excited and I'm ready to go.
Are you viewing it with someone?
I'm a little bit of an amateur astronomer. I got my goggles and I'm ready to go.
Yeah, I'm more into astrology. I know nothing about anything else.
Oh,
yeah.
Well, maybe check what the solar eclipse means for you.
I will. The sun has been primed. I'm all into it. Right, let's dive in. Wayne, welcome to the show. The weather's been very hot this summer. It's been scorchio. How has that impacted European high-yield credits this summer?
Basically, what we've been seeing is the Rhine River and the River Danube in Romania. They've been at record low levels due to evaporation from the heat that we've just spoken about.
Yeah.
What that has meant is that a lot of the chemical companies which operate along the Rhine River, they're not able to move around the products that they make, and they're also not receiving the raw materials which they need to make their products. Along the River Danube, what we're seeing is that the nuclear power plants, they're actually struggling to get the water which is needed to cool down the nuclear plants, which means that energy-intensive companies like car manufacturers like Ford and Dacia, they aren't able to operate at the levels that they would otherwise operate at.
And are these car manufacturers around the Danube and the Rhine that you mentioned?
They're not necessarily around the rivers, but they rely on the energy that's produced essentially by the Danube.
Okay, interesting.
So yeah, and this really doesn't seem to be at the forefront of many people's minds at the moment. So like if we go through like the earnings calls and stuff like that, it's only really the players that were affected in 2018 that people have really been questioning. So the two main examples would be Lanxess and BASF, which are both German chemical operators completely focused on that Rhine River area.
So it sounds like this is not only contained to those chemicals companies and that particular sector. You've mentioned a couple sectors there that could be impacted.
Yeah, I mean, to be honest, that's not even the full list. So there's actually ice cream manufacturers, paper and packaging companies, camping, hotel providers,
Nice.
care home providers. Everyone's being impacted in their own way.
Ice cream manufacturers, what's the impact on them?
So the ice cream manufacturing, that's actually quite interesting. So basically, you need a lot of water to make ice cream, I guess, because it's liquid. You need a lot of milk.
Right.
The milk is impacted because basically the grass isn't as good because it's so hot.
Right.
And then the quality of grass basically means the cows have a lower yield.
Okay.
On top of that, aside from this extra heat that we're talking about, we also have the weather system El Nino, which is basically affecting crop yields on top of this current drought that we're having as well, which means things like cocoa and sugar are going to be more expensive. Again, these are key ingredients you need to make ice cream. On top of that, ice cream is obviously cold, so you need to keep it cold, right? Which takes energy. And like we said, the energy that's being produced in Europe, not all of it is nuclear, but some of it is also hydro as well. You can't generate as much electricity, right? Because you have less going through the hydropower stations and then also less cooling for the nuclear power plants, which basically means that the cost of energy is going to go up. So they're basically being hit from
all sides.
All sides, basically. I guess with the ice cream manufacturers, the one caveat you sort of have, or the one like a offsetting tailwind you have, is that it's hotter, so people will potentially buy more ice cream.
Yeah.
Although the question is, do you buy more ice cream at 30 degrees compared to 40, or you just buy the same one ice cream on that day?
Or you just flop. Anyway, I was going to say, but this is contained to just one summer, right? This isn't something that's going on throughout the year.
No, you're wrong. And I think why it's actually interesting is we've actually seen this repeat 4 times in the last 9 years. So we had 2018, 2022, 2024, and 2026.
And as journalists, 3 is a pattern. So if it's 4, then it's definitely happening more.
Exactly. And I think what's interesting here is actually, so 2018 was the last really bad, well, the first actually, but also the worst drought that we'd previously had. And we'd seen the river gorge depths that had gone down to around, I think, somewhere just above 30 centimeters. And some of the smarter companies like BASF, they basically invested in these low water depth barges. So the minimum they can go to is around 30 centimeters. However, this summer is worse than the 2018 summer. So what we're seeing is that the water gorge depth has actually gone down to, I think, around 15 centimeters, which basically means that no barges can cross through the
15 centimeters, that's just like my foot.
Yeah. Exactly. And actually, the Corb is probably the most impacted region of the Rhine River. It's basically the lowest point, so it's kind of like the choke point of the river, and that's where most of the ships are struggling to, or the barges are struggling to pass through. In the upper parts of the river, I believe things are fine, actually, at the moment.
So you say that they've invested in some of these low water level barges. How much can that actually offset the impact? Because presumably this is only going to get worse, and at some point you'd expect some of these rivers to dry up altogether.
I'm not going to go as far to say as that they're going to completely dry up, but I would say the fact that they're supposed to operate at 30 centimeters and now we're down at 15 centimeters, those investments are basically, I don't want to say worthless, but they're going to prove ineffective now. I think the most recent news I've seen as of this week is that there's basically no shipping passing through the Corb region at the moment. So,
wow.
Yeah.
I mean, what I'm getting is that we need to have a seance for rain. Do some rain rituals.
Yeah, I don't know if any analysts have been asking these companies if they have been in touch with the Etsy witches.
I don't know who the Etsy witches are, but I guess that might be a decent shout.
That's something for you to look into.
Exactly.
You mentioned that you don't think people have been paying enough attention to this. Analysts aren't usually ones to skip over emerging trends. So why do you think there is this sort of complacency?
I think it's to do with the timing. So a lot of the public issuers, they've recently reported from the earnings calls I've covered, it's basically people are just focused on the Rhine. I don't think they're actually thinking about the wider impacts. Probably also worth mentioning that chemicals is basically the base of all manufacturing in Europe, right? So
I think that's why you love it.
Yeah. I think there's potential knock-on effects there that we're not considering. But from what I've seen so far, I've seen it mentioned in Lanxess calls, INEOS Group's calls, and BASF.
Okay.
Yeah.
In terms of any particular issue or names you're looking at, what's the divide between the bigger players and the smaller players, do you think, that are going to be affected by this?
So I think the bigger players, just purely because they're bigger, they're larger, they're more diversified, they're probably going to be more resilient to it. The one thing that you'd still want to look out for is that they don't talk about any force majeure or like having to close any factories because they're running short on supplies. But INEOS as well as BASF actually, they also invested in similar things. And INEOS actually has sort of like a dual supply chain. So as well as receiving and exporting on the barges, they also have pipelines that they can use to receive and export out their chemicals. So they're a bit more resilient on that side. But speaking about going back to German chemicals, there's actually an issuer called Currenta, and they basically operate all of the chem parks along the Rhine River. So that's one that I think people should probably definitely look out for, because most of their top line is basically driven by volumes. And obviously if the companies are producing less and you're having these recurring issues, it's kind of something you want to consider for a name that you're underwriting. So yeah.
Nice.
So you mentioned Currenta. Are there any other names on your sort of watch list right now? What would you point to in terms of issuers that could see impacts from this?
So I think any of the metal and glass packages, glass especially, it's a very water intensive process.
Okay.
Also, you have to draw water from the ground if you're not drawing it from the river, right? So if there's a drought, it's going to be harder to extract the water. Even if you get it from a municipal, you're probably going to have to pay more for that. And then also the issuers that have unhedged electricity exposure and also require a lot of electricity for the reasons we mentioned before about hydropower generation and nuclear energy, both requiring a lot of water. Those guys, they're likely to see their electricity crossing increase.
Fantastic. I think this is so fascinating.
Yeah.
And I think it also points towards a sort of future in which analysts, journalists, and the whole of the wider market has to be thinking about these kinds of climate risks. And I don't know, maybe a future in which climate risk, climate insurance, climate finance comes out of that sort of silo and starts impacting every single area of business.
I mean, that's actually a good point as well. So from what I've seen, most insurance policies don't seem commercial or residential don't seem to cover this. So that would be something to look into in the future.
For sure.
And it's probably also worth giving a little shout out to our ESGX project because I use some of their work to help me find some of the names that might be impacted.
Amazing. Well, thank you so much for joining us. I mean, since it's the eclipse today, whenever that is, I think this is an opportunity to do some kind of rain dance ritual.
Oh,
as
no.
the sun is
I'm
being
not a dancer.
primed.
I'm not a dancer.
As the sun is being primed to lure the rain to fall so that we get up to 30 centimeters. And on that note, thank you so much.
Thank you.
Before you go, we've got a little game up our sleeves that we think you'll be good at. You'll be wanting to do well. There's a league table and there's a leaderboard. And I might throw in a spanner in the works for good old fun.
Okay. Let's
Katie,
go.
you want to give him the scoring system?
Yeah, so you're guaranteed winner/loser in my scoring system, which is completely simple and uncomplicated. I think you're going to place very highly on the board unless we turn it upside down or turn it twice, 360. So we're going to describe a corporate action. You're going to tell us, is it, in your opinion, a power move or a panic move? And make the case for your answer. So I think these will be some...
It should be fun. You'll be good at this. You're a great
Also an
analyst.
explanation.
Yeah, so this is about a company, this question, 22 billion cap stack. I think it lost 30,000 broadband subscribers this quarter. It also managed to give a 200 million shareholder distribution. Was that a power move or a panic move? In your humble opinion.
Can I give a third? Like, is there option C?
Go wild.
I think it was a misunderstood move.
Okay. Oh, I like that. Why?
The reason being, and I'm not super familiar with the VMed structure, is I understand it's to fund the startup of operations elsewhere, just outside of that credit box, but for a different business, which I believe they're carving out.
Yeah.
But don't kill me in the comments if I'm wrong. Like I said, I don't follow the telecoms names very closely.
Well, you're correct in that. We're talking about Virgin Media. We're going to delve into that a little bit more after you're gone.
Yeah.
But you're putting it down as a power move, misunderstood as a panic move. Did I get that?
Misunderstood as a panic move.
Right.
Misunderstood.
Okay. All right. Noted. Okay. Next one. Question 2. We're going to stay closer to one of your patches this time. It's a European chemicals major. It deferred its planned CapEx expenditure. It started exploring disposals of its non-core assets. It was citing weak demand, rising input costs. Power move or panic?
I mean, that's definitely a panic move. I think it could be considered a prudent move, right?
Oh, I like that.
Okay.
Just saying.
You really do think outside the box. I like that.
Yeah. I think that's one of my
Next question.
qualities.
A company switches part of its cap stack to PIK toggle notes, giving itself the option to pay interest in kind rather than impact its cash flow. Panic or power?
Again, I don't have a straightforward answer.
Of course.
I mean, to be fair, it's a bit of both, right?
Yeah.
But that's the optionality that you built into that specific security when you issued it.
Yeah.
If I have to pick one, I'm going to say panic.
Yeah. Because typically PIKs are a bit
PIK eats away at your equity value. So if you're doing that, it's more of a panic than power move. But
Okay.
yeah.
Fair enough. All right. Question 4. A private equity sponsor takes a dividend recap out of a portfolio company roughly 18 months after the original buyout, and it's funded by new leveraged loans. What's your take on that?
Is the company in distress? Or is that not part of the question?
The company has taken a dividend recap roughly 18 months after
let's
the
make
original
it this
buyout.
Do you know what? I think it's a power move.
Oh,
It's a power
really?
move. But typically what I find is that companies tend, like a dividend recap, basically, in my mind, it doubles your chance of distress. I think there's actually a study by Fitch that confirms this, but a lot of companies do a dividend recap and then lo and behold, there's trouble down the line. Too much leverage.
I'm going to throw a spanner in the works now. Would you rather hold second lien paper in a performing company or first lien paper in a distressed company?
What kind of investor am I?
Ooh, that's a good one. Let's make you a vulture fund.
First lien paper in a distressed company.
Why?
Because I'm going to skip a bunch of steps here. Let's say the company's distressed. We have to RX, depending on where the value breaks, it's likely that I'm going to be in control, take the lion's share of the equity. The company is basically private. You can turn it around and then hopefully, well, I guess this is old school distressed investing, right?
Yeah.
Hopefully then you can maybe sell it to a strategic or a P in the future once things have been fixed, and you'll probably make a better return than second lien in a performing company. But that will probably require a lot more patience and maybe further investment. But
I like that response. Yeah. Okay. So first lien
Sorry, guys,
in a stressy company.
I can't
That
give
is then.
straightforward answers.
Should we wrap it up there? I have the scores tallied. If you just give me one moment, please.
Yeah, Katie's got a weird scoring system.
I don't like
So we've got
non-transparent
Rafi.
scoring.
We've got Rob Shack, who was actually leading, but Katie said he's not. So we had to discount him. So I don't know what this is going to be like.
Can I
Right,
bribe
the
with
results
internal
are in.
kudos?
The results are in.
Results are in. All right. It was a difficult one to score. We went off piste at times. I will say you've gotten several bonus points for your refusal to get in the boxes that we tried to force you into.
I love that.
You got out the box critical thinking. I love a critique of the quiz itself.
Bold.
And overall,
Drum roll.
you're coming out with a solid 94%.
Oh, wow.
Where does that rank?
What?
I want to know where I
You're
rank
2
against
percentage
my
points
colleagues.
above Rafi.
Rafi.
You're 6 percentage points above Rob Shack.
Yeah.
Okay.
And
There we go.
That's good. That's great.
that's where you are.
Yeah.
Do you
Congratulations.
guys want me
Top
to-
of the leaderboard.
Do you guys want me to reverse score you as well, or?
No, that's a bit cheeky. You are a guest here. Know your place.
Okay.
I mean, you can do it, but I will say
it was gonna be
scores are
positive.
never final here. So you're welcome to reverse
Okay.
scores.
No,
However,
no,
you
no.
may find
I
that
withdraw
there's
my
some
comment.
adjustment.
I withdraw my comment.
All right. So
It's been
thank
fun
you
having
so
you.
much.
It's been
Thank you
fun
so
having
much.
you here, Wayne.
Thank you, guys. It's been fun being here.
It's
Of
been an
course.
absolute pleasure, and I know you'll be keeping your eye on the weather, on the rainfall on the Rhine, and other such important dynamics in the European markets.
Yeah, I think you've got something coming out, right? You're about to publish something.
It should be
on
published
this.
by the time of the podcast.
Okay,
By the
good.
time
So
this
you
is
guys
published.
check it out.
Yeah.
Wayne's piece on the
I'll put the link
Scotch
in the
all
comments.
summer.
Yeah.
That's been Wayne's World, everybody.
Yeah.
Wayne's World. Bye.
Thank you.
So VMed.
Virgin Media.
I know, to the credit heads, this is a thing. Okay, we're making credit heads a thing. It's got a 22 billion cap stack. It's got years maturities in 2029. But given its sizable debt pile, I think many people are a bit worried that it potentially could be like Altice.
Okay.
VMed has had a few eyebrow-raising moments, which Katie's going to talk us through, but I think it can be greatly distinguished from Altice.
Yeah, so it's been a rough couple weeks for VMed. It's UK's second largest telecoms operator. It's a joint venture between Liberty Global and Telefonica. There's a £500 million senior unsecured note in there due 2030. And that dropped down into the low 60s, about 10 points after Q2 earnings came out.
Deeply distressed.
It wasn't really about headline numbers. It was more about a much weaker than expected fixed broadband quarter. So they've lost close to 30,000 subscribers.
But I think its story probably, it's kind of a lead up to that. So they've had about 5 to 6% year-over-year revenue decline over the last 5 quarters.
Right.
And this is driven by the fact that they haven't been able to install these fibers quicker enough than their competitors, basically. Their rollout speed's been tortoise-like. But what's got to be in everyone's bonnet is that I think they announced in one of their earnings that they're paying a 200 million dividend. And that's not really big for a company like VMed. But I feel like people are like, well, your bonds are tanking. Why are you like value leaking right now? It's not a good signal, is it?
Yeah, absolutely. And I think as Wayne mentioned earlier, management has kind of tried to make the argument that this is essentially going to be a reinvestment in the company. It's going back through another subsidiary. It's all a bit complicated, but investors aren't really buying it.
Yeah.
And that's pretty clearly shown in the CDS. So 5-year protection on Virgin Media Finance, it flipped from being quoted in basis points to trading up front and 27 points at the back end of last July. So you're paying 27% of the notional just to get the protection on.
Yeah.
That's the widest of all 75 names in the iTraxx crossover index, or it was at least at the time, a couple of weeks back. Net leverage is about 5.89 times. That includes vendor financing and leases. only up marginally from 5.86 as of Q1, but management's own target is for 4 to 5 times in the long term. They have not specified by when they would like to get there or the path to do so.
But I think what's also interesting for listeners or credit heads is that what it gets interesting is they've got these vendor financing notes, or VFNs as we're going to call them.
Right.
It's about 3 billion. And the structure is very convoluted. I think I saw the lawyers scratching their heads when they were just trying to figure out what does this mean in terms of recovery? And there were some concerns about its structural seniority relative to unsecured notes. However, I think our Octis analysis from the covenants team found that the VFNs were structurally senior to the senior unsecureds, but effectively subordinated to the senior secured. That's a bit of a mouthful.
Right.
But there's always a caveat.
So they're coming in between. Basically, you've got your senior secureds, your VFNs, then your senior unsecured.
Perfect, yeah.
The VFNs in our base case waterfall were covered in full in a restructuring scenario, same as a senior secured debt, but the senior unsecured basically look to be wiped out in the base case. Absolute zero recovery.
Zero recovery. So what's the what here for listeners? Well, for VMed, there's no real immediate near-term liquidity crunch per se, because 2029 is the nearest maturity. It's got some total liquidity of about 1.7 billion. And this isn't a company's about to run a cash kind of scenario. It's got 1.7 billion and it generates about 10 billion in revenue with about 200 million of free cash flow after leases.
All sounds pretty healthy, doesn't it? Pretty big liquidity cushion there.
Quite different from Altice, really. And it's also got multiple shareholders, unlike Altice. Yeah. So there's no Drahi-like stuff going on here.
Right. So leverage problem, confidence problem, not yet a liquidity problem. However, when your senior unsecured curve is pricing something closer to 50-50 proposition and your own shareholders are paying themselves a dividend within days of a bond sell-off.
A puny one.
Just a little dividend for me, please.
Yeah, sprinkle.
Oh, I'm not very hungry. I'll just have a £200 million dividend, please.
Yeah. We should take this seriously.
So the next real test is going to be whatever business plan update Liberty Global promises the market. So we are watching on that. And our covenants team has put out an analysis on the potential liability management risks here. So subscribers should check that out.
For sure. So I think we've had a great time with Wayne today. It's been scorcho in Europe.
I think we've handled the whole episode with equanimity. I think investors are handling the Virgin Media story with equanimity while they look to see whether liquidity will be enough to cover the high leverage. I think that the only thing I honestly cannot handle with equanimity is, the impending climate crisis. But, TBD, we can't solve all the world's problems on this podcast, can we?
Of course. Yeah, we'll wait until winter and probably give an update then.
Sounds good to me.
Yeah. And on that note, see you in 2 weeks.
See you then. Bye-bye.